The following is a pre-recorded show. Welcome to Winning in Retirement with your host, Brian Akers, certified financial planner professional and founder of Akers Financial Group. Now, helping you win in your retirement, here's Brian Akers.
Good morning and welcome to Winning in Retirement radio podcast. This is Brian Akers from Akers Financial Group. I'm here today with Jeff Akers, also from Akers Financial Group. We're also certified financial planner practitioners, and we're also cousins from different fathers.
What else are we?
And different mothers.
And different mothers, too.
Just
same grandfather.
Just to be clear.
We do have a same grandfather and grandmother. That's what cousins are.
In case you're keeping score at home. This show is called Winning in Retirement. Yes, it's a radio and a podcast. You can listen to it live. You also can hear it recorded. You can go to our website and hear it recorded over and over again. And you can just find it on the podcast networks everywhere. Winning in Retirement.
Yep. And lots of people say that they love Brian's voice. That's why they go back and listen over and over again.
Why are we starting with my voice, Jeff? Is this for easy listening so that they can calm down and helps their toddlers sleep well at night? Is that what that goes on?
Well, I wasn't going to go there, but...
All right, so today's show is going to be called Generosity, Tithing, and Legacy. Jeff is being generous with his jokes already, so I thought we'd start with that. So my thoughts are this. Winning in retirement is a result of making money winning decisions throughout your life. Money winning decisions helps you to be winning in retirement.
Oh, so you
How about
do
that?
the right thing with your money over time, and then you've got money to give? Is that where you're going?
Yeah, that's pretty deep there, Jeff.
Okay.
As you prepare and handle your finances, there will be a day where you see money as just a tool, not as the only outcome. As you win in retirement, your finances grow, an actual heart for things like generosity, especially to others, to other events, other things, community, to God, to other things that are going on in your life, even for legacy. How do you do this? Well, that's exactly what this show is all about. It's about generosity, tithing, legacy. All right, Jeff, so that's going to be a tough subject because it's a lot of things.
Right.
Trying to wrap it all into one. So we got to start with some basic stuff first, right?
Well, yes. Yeah, generosity kind of is, I think of as kind of an umbrella because tithing, legacy, I see that as part of generosity. So
yeah, so generosity, is that just only for the wealthy? That would be one question to ask.
No, generosity is something that we can all be generous. And generosity is not limited to money because it can also be time.
Sure.
We can be generous with our time.
Yeah, so what happens is this. Winning in retirement many times isn't about money. It's about what are you going to do when you're retired? What are you going to do with your time? What are you going to do with that money that you've saved and built if you have leftover money, or what is the priority of your money? So what happens is this, is we need to talk about the financial side. There are deductions for things such as charity and giving.
Sure.
And then there's some things people need to know about. They think they get a deduction for charity and they really don't.
That has happened sometimes.
Maybe many times recently. So we're going to talk about some basic things here in the first quarter. And the first quarter is this, charity.
Okay.
What is a charity?
Well, there's the government definition of a charity.
And that all that matters, right, for tax deduction?
From a tax standpoint, yes. That is all that matters. There's like a 501c3 that
Sure.
we've heard of, and those are recognized charities by the IRS.
Yeah, so qualified charitable charities, and those are actually on the IRS website, will say these are qualified through the websites.
Right.
And through the process of being approved by the IRS, which can, if you want to start a charity, it takes you probably 6 months to get through the whole process to get it set up.
Right. So you can look and make sure that the charity you want to give to, see if you're going to get a deduction for it or not.
Mm-hmm.
That's fine. But if you're giving to the charity just for the deduction, I'd say you might want to think twice about how you give, because I think charity is more about the heart than about getting a deduction for it.
Yeah, because the heart in giving. So let's go with that option for a second. Let's say someone has $100 and they say, "Oh, I can get a $100 write-off. I need a $100 write-off."
Right.
Or do they give because there was a need that they saw, and then I get a write-off.
Right. It's, you kind of described that just about perfectly, I think.
That's what we do here at Winning in Retirement.
There you go.
I'm sorry.
There you go. Yeah, because the idea is your heart is in it, you give to it, and then later on you recognize, oh, wait, I do get a benefit from this with a tax deduction.
Now, the question is this, do you really?
Do you really get a tax deduction?
People say, oh, I'm going to write off my taxes. And then they go to do their taxes. What section of a tax return do we take a charitable deduction?
Well, that comes on Schedule A.
Schedule A. So you have to itemize
your deduction
as compared to standard deduction. That's the main topic right here.
Okay. Yeah, so standard deductions right now are pretty high.
And that's because of the Tax Cut and Jobs Act of 2017 changed the tax law where it brought exemptions and standard deductions all in a big pile of money.
Yep.
And almost made deductions like medical and charity and even our SALT deductions just disappear.
Yeah, SALT, state and local taxes. A lot fewer people have been able to itemize deductions over the last several years because of such a high standard deduction.
So give me examples. Like back in 2023, the deduction for standard and itemized, what kind of estimate or numbers were there?
So married filing jointly, the standard deduction was $27,700, and that's if you're under 65.
Okay, then it gets a little higher over 65.
Right. If there's a married couple, they're both over 65, it's $30,700.
So if we walk that number through, a married couple, you make your income, that's your adjusted gross income. Then you subtract out a standard deduction or itemized.
Right.
The only way you can do an itemized is if you have enough expenses that are greater than standard.
Right.
There's an exception to that, of course, where you can also waive that right because of the way you play the Maryland tax return, which that's not this show. Right. But I know someone's listening to this show and going, I caught him.
There's a time.
And there's an exception. Almost everything there's an exception. So
yeah.
So the idea is this, itemize. Imagine you have a Schedule A. The first thing of that is if it's $27,700 for married filing jointly.
Right.
$10,000 is the max for SALT. And what is SALT again, Jeff?
State and local taxes. So that's your property tax, your state income tax, those kinds of things.
That's also for your first house, your second house, your first house, your second boat with a kitchen and bathroom or a head, your RV with a kitchen and a bathroom.
Well, if you got a boat, you got a head, I guess so.
Yes, and so these are things that could be deductible up to a limit of $10,000. That means $17,700 is the rest of the deductions that you could take on the itemized. And that would be a combination of medical after a minimum.
Yeah,
and then there's charity. So it's almost that once you give more than $18,000 to charity, all of a sudden you're going to be able to go up.
Right. The other thing that's counted in there is mortgage interest.
Yep.
But ideally, once you've made it to retirement, you've paid your mortgage off, so you don't have any mortgage interest.
Right. So people that have higher mortgage interest, especially now where the interest rates have jumped up, the mortgage interest deduction is getting bigger because everybody had low rates, so really didn't have a big deduction anymore.
Right.
But now it gets bigger, so maybe the itemized might start coming back for those that have mortgages with higher rates.
Right. So Brian said before, you might give to a charity and think, oh, I'll write that off. And then you do your taxes and realize, but the standard deduction's already higher than what my itemized would be.
You don't qualify, right?
You don't write it off.
Yeah, so state and local taxes can include your real estate tax with the state and local, so that's hard to beat depending on where you live.
Right.
Especially Maryland.
Right.
We're top 6 right now for taxes. We're shooting for number 1.
Yeah, but we're still limited to $10,000 on that line.
No matter what state you're in, what price of house, you get limited at 10.
Right.
That will go away in 2026 when the law changes. That's the current,
that's current
sunsetting.
Law. Yeah.
Now, the idea is this. You have your $27,700. You take out the 10, you're at $17,700. If you have mortgage interest of, say, $10,000, you still have to have $7,700 of charity to be able to take it as a deduction.
Just to reach the amount of the standard deduction.
To be flat.
Right.
So you throw a couple $100 here or there to charity, you're not getting a deduction. Itemized or charitable deduction goes against your income.
Yeah.
And that goes against your income like a dollar for dollar off of the adjusted gross income. It's a income credit, not a tax credit.
Right. It works it's how they calculate your taxable income. What's the amount that's going to be subject to that tax rate?
Sure. And so what happens is that if you get enough charity to get above the standard deduction, you then can start deducting it.
Right.
And so what happens is that when you look at your return, you're seeing that it's further down in the return. So you have all the other limits up top. Then you have the itemized deduction. Right. Now, Social Security taxation is affected by all the numbers up top, not what you itemize for.
Right. Yeah, so giving to charity or itemizing your deductions isn't going to reduce the amount of Social Security that's subject to tax.
Correct. And so the idea here is there are some techniques here on tax planning when it comes to generosity and tithing and legacy. Not that we want tax to be the number one thing, but to understand when it works, when it doesn't work.
Right.
And so under this law, there's some general ideas. One idea is if you want to give money and it's going to help you get the itemized, maybe you do next year's giving and this year's giving all in December or at the end of a year to be able to lump them together to qualify above.
Right. Get 1 year with the itemized deduction, and then the other year you're going to take the standard deduction.
But the main point I want to make is this, that generosity is to give money or give time away. That's going to come from your heart rather than a deduction.
Right.
Because many people can't take the deduction once they do their return.
Right. And so we just don't want you to be surprised when you go and do your taxes and say, wait, I thought I was going to get something off for this.
Yeah.
Because, well, we want it to be from the heart so that then you're not upset when you realize that you didn't get a deduction for it.
Absolutely. So the idea is this, generosity, when it comes from your heart, you're not really worried about the tax deduction. You should keep track of it, all your receipts, everything you do, everything you give to, and having one folder or one electronic folder where you can give it as you're doing your taxes, so you have it all together. Because it is best to have receipts for absolutely everything, have it all listed out, so you can take the full deduction when it's time.
Right. And just keep in mind that giving and generosity, charity, all that stuff is more than just money. If you're driving for a charity, you can deduct mileage sometimes. So we just want to keep track of that kind of thing because it'll add up.
So Acres Financial Group, we host Winning in Retirement. We also have a company called Daniel Allen Tax. It's a pure tax prep business where we have an accountants that work full-time that help us with our clients' taxes. We refer to them. We also use many other CPAs around Maryland, Pennsylvania, and around the country to help deliver the answer and the tax estimate and the advice that we need to do. Acres Financial Group, we're local. We're independent. We don't report to a big company on Wall Street. We report to you. We do have offices in Lutherville, Forest Hill, clients all around this Mid-Atlantic region, and even all around the country. It's so easy to begin winning in retirement. Just give us a call and schedule your meeting with one of our team of advisors. Call 833-WIN-RETIRE. That's 833-WIN-RETIRE. We'll give you a call on Monday to schedule your free in-person or Zoom meeting. Go to acresfinancialgroup.com or call us at 833-946-7384 to start planning for your retirement now. Does your money show where your heart is? We'll explain in a moment.
You're listening to a pre-recorded show. Welcome back to Winning in Retirement. Call 833-WIN-RETIRE now to schedule a visit with Brian and his team and begin winning in retirement. Once again, here's Brian Akers.
Welcome back to Winning in Retirement. This is Brian Akers, President and Founder of Acres Financial Group. Here with me today is Vice President of Acres Financial Group, Jeff Akers, Certified Financial Planner Practitioner. And today's show is about not just winning in retirement, but having money-winning decisions to help you win in everything you do. Here in the second quarter, our topic is, does your money show where your heart is? All right, Jeff, this is the quarter, second quarter. I'm throwing you like a softball. Does your money show where your heart is? I know this matters a lot to you. I want to make sure we cover it thoroughly.
Okay, yeah, you're throwing me a softball, and then I'm going to run in a new direction. I remember years ago, the saying used to be, show me your checkbook, and I can show you where your heart is.
Yeah.
I guess nowadays we'd have to say, show me your Venmo, and I'll show you where your heart is. You know, however we pay things now, it's changed over time.
Still a checkbook. Might be online instead of a piece of paper.
Oh, yeah. Show me your bank statement. There you go. But the bottom line is where our heart is, that's where our treasure is.
Yep.
And so if our heart is in a certain charity, a certain thing in the community, then just naturally we're going to give towards that. It might be time, it might be money.
Yep.
For me personally, I go to church. I believe in tithing. Well, tithing is 10% of my gross income. I went gross there, but it's 10% of my gross income that is just kind of a no-brainer. That's the first thing is to give that. And I'll just say that years ago, as I was starting to get into the practice, it was hard to do. But as I've gotten to where it's easier to do it, it's a little bit like your taxes. If you notice when you get your paycheck, they take the taxes out before you ever see the check. Well, if I go ahead and give the tithe before I think about anything else, then what's left is how I pay my bills.
And you get used to living off the net.
Right. I get used to living off the net, and as odd as it sounds, the net continues to increase. And so then there's more that I can give and more things that I can do.
All right, so the idea of tithing. Tithing is from the Bible. It is designed on a 10% of your first fruits. That's where the gross comes from. Mm-hmm. Now, we're not judging people based on that. No. We're just saying that that's what we believe based on what we read. Right. But that does not mean tithing has to be that for you. I believe that tithing needs to be understood, and you need to look at where your money's going. Does it reflect your heart? Mm-hmm. We say things in life such as, "Oh, I love God. I love this. I want to support my local church," and then people don't tithe.
Right.
As a financial advisor, we call our clients on that sometimes.
Yes.
I call myself on that sometimes, because what happens is this: when you make money, and the first thing you're thinking of is how to spend it, that's not where your heart is, right? That's not that your heart would be on the spending. Your heart's not on the generosity, the giving, the tithing. Right. The way to honor where money comes from and where it all comes from is by giving to it first.
Right. Make that the first thing. And now, don't get me wrong. What you give to, it doesn't have to be a church necessarily. Mm-hmm. I work on a board for the ARC. So if your heart is with folks that have developmental delays and need help in the community, that's something that you can give to show where your heart is.
Right. So one of the things that when I think about this, I think about what's happening throughout my life when it comes to giving and generosity and where it's gone. And so it starts like this, in that you got to understand where the money comes from, your job, the benefits of life, and I believe it comes from God. Then we tithe in that manner to the church, synagogue, wherever we serve God at. Right. And we need to do that. Now, after that, you can give over and above to many other things. Right. Now, some people will, it depends on the percentages, and I believe that the ultimate decision comes down between you and God. Yes. And so I actually pray to God for a vision from God, for God's vision and a heart for things that need support, so that I would be directed by God to understand where to give money to so that I can see the need.
Right. We ask God, what is it that you want, and please get me in line with that.
Yeah, absolutely. So when we talk about is your money where your heart is, it matters to us.
It does. And like Brian said before, if you get your paycheck and the first thing you think is, how can I spend it? Okay, your heart is on stuff that you want to buy. And so, we'd encourage you to kind of think a little deeper, and where do you want your heart to be?
If you have financial troubles, it doesn't mean that if you tithe, you'll get wealthy. We don't believe that way, but the idea is this: if your first thoughts are on something different than spending, or it might help prevent you from getting deep in debt. If you're already deep in debt, you might have to do a combination of starting the tithe, to start to acknowledge that you give something, and then you start paying off that debt, and then the priority of the continually spending becomes a problem. You try to stop that through the budget planning. Those are tough decisions.
Right.
The crazy thing that happens is clients make more and more money, that 10% tithe gets a little harder to do.
Well, it becomes a bigger number.
Absolutely. They think, I made $500,000 last year. Do I really have to give $50,000?
Well, you said have to. I don't like the word have to.
I'm just repeating what I know someone asked me, not recently, but this year. And I said, well, that have to is the main problem with the question.
Right. Right. Give that part up. Brian mentioned earlier that a lifetime of money-winning decisions puts you in a position where money is a tool that you can use and you can give to different things. The idea behind that consistent giving, and when I say consistent giving, I'm thinking in terms of the tithing, it builds a good habit, and that good habit will benefit you throughout your life, because then your eyes are not on that material thing that you want to buy all the time. You look at things and you say, well, okay, that's nice, but I don't need that. I'll take something else. And it just builds these good positive habits that allow you to accumulate more and more wealth over time. It's not because God says, oh, you gave to me, I'm going to give you a bunch of money. That's not how it works. But it does build good habits, and those good habits will benefit you throughout your life.
There's many, many stories of giving. One of the things that's hit the news the last decade or more has been the billionaires signing this pact, like the Bill Gates and Melinda Foundation, where they have all their billionaires basically agree to give most of their wealth away, and then their foundation helps them with that, and they spread it all around the world. There's many wonderful things going on, helping schools and just different parts of every country. It's pretty cool. There's lots of foundations, lots of work being done, from disaster relief to building houses. I was trying to think of all the ways my clients try to help people, but
Right.
Just a few of the things is that when we do different types of planning, we give directly to these charities that people build a list of.
Right. And here in the U.S., we are so incredibly blessed. When we look at what's going on around the world, other places in the world, there's a lot of needs out there.
And so when you give the charity, you do have to be a good steward. You need to know if that charity is actually going to deliver that money to the charity to the place you want.
Right.
So it's very important to understand their finances, to look at it and to say, well, what's going on there is if I give $100, how much gets to the charity that I want? Is it $50?
Right. Are they going to dig a clean well in Africa, or is the head of the charity going to take some great vacation somewhere?
Right. And so understanding who you give through, how you do it, what box you check, where you send the check, make sure you understand it's being used and done properly, I think is very important.
Right. So where is your heart? And then do some research about the charities that kind of show where your heart is.
Now, tithing 10%, sometimes I like to think about tithing of time.
Mm-hmm.
And like you try to think about your year and what do you do. One of the best things for my family has actually been doing mission and outreach work as a family. We've done that for over 20 some years, 1 week a year, where we take that and run things like mainly local basketball camps. That is what we've been doing recently. But that's been a big thing in my family, and it's been one of the better things we've ever done.
Right. So Brian's heart is basketball and serving God. So he puts the two together, and that's a great way to give of your time.
And there's other ways to give. I know I have friends of mine that are on disaster relief, where they basically get a phone call. Hey, we got to shovel out a certain area, like Eastern Shore had some projects recently, and there's different crews that people can get on to be able to help.
Right. I talked to someone yesterday who they're involved in an organization that sends Christmas gifts to places all around the world where the kids are less fortunate. And she actually took a trip to one of those places to give out the Christmas boxes.
Absolutely.
To those kids. And she can't stop talking about it.
Now, Acres Financial Group, we believe in community involvement. We reward our employees for doing that. We believe in community involvement as a company in each and everything we do. We're trying, when it comes to honoring the community, the people, our God, all that with money. That is really what we're trying to get here in the second quarter is when you think about your money, where is your heart?
Right.
That's a hard question.
Yeah, it is a hard question when you've got to answer it with your finances.
Yeah.
Jesus talked about money a lot,
mm-hmm.
and it's because it's important. He knows it's important to us. And so he talked about ways to manage it, to take care of it.
Yeah, there were 2,000 verses in the Bible that reference money and about good stewardship and handling money wisely, and that's exactly what we're trying to talk about.
Right. So the idea is where your heart is, research those charities, and make sure that you're actually supporting what it is that you want to support through that charity.
And audit it. In other words, go check them out, see
Right.
what's going on. It's very valuable. And get involved in the things you give to. So it's not just throwing the money at it. Give some time to it, and then you'll be able to see even more on hand how it's actually being used. You might be able to do more direct investing.
Right. Sometimes it's easy to write a check, but when you actually show up and do some of the work, that's where you really get into it.
And then that heart grows, and you start to see. It's almost like if you buy a blue car or a red car, the day after you buy one, all of a sudden you're on the road, and all you see are blue and red cars.
That's right.
Same thing as giving. It's like I started giving, all of a sudden I find 5 more things I like to give to.
Mm-hmm.
Oh, now I got to pick and have it prioritize which is the best.
Right. And we don't want you to be in a position where you're thinking, oh, I'd really love to give to this. We want you to have those good habits so that you can give to those things.
So what we're talking about is this. At Acres Financial Group, everything we do is about you and your decisions. Your retirement, your financial planning is as unique as your fingerprint. When you sit down with us, we start by taking a look at where you are financially. We talk about you and what you care about, and we start with that. That's where we start right now when it comes to your net worth, your income, your investments, really understanding where you are so we can accomplish the goals that you have for your finances. Perhaps you've been sold something regardless of whether you need it or not. Not at Acres Financial Group. With us, your retirement money follows your financial fingerprint. It's a retirement plan based on unique financial fingerprint that determines where your money goes. It's not about us, it's about you. So give us a call at 833-WIN-RETIRE and schedule an in-person or Zoom meeting with one of our team of advisors. That's 833-WIN-RETIRE, 833-946-7384, or visit our website at acresfinancialgroup.com. Scroll down to the bottom of our homepage and schedule a meeting right there. Call 833-WIN-RETIRE or go to acresfinancialgroup.com. At what age can you give straight from your retirement accounts? We'll let you know in just a moment.
You're listening to a pre-recorded show. Welcome back to Winning in Retirement. Call 833-WIN-RETIRE now to schedule a visit with Brian and his team and begin winning in retirement. Once again, here's Brian Akers.
Welcome back to Winning in Retirement, a radio podcast put on by Acres Financial Group. I'm the host, Brian Akers, with the other hosts, my man, my cousin, my Jeff Akers.
Jeff Akers.
I should have ownership of Jeff Akers, though. I shouldn't say it that way.
Well, you are older than me. You were born before me, so you've
yeah,
been my cousin my whole life.
Yeah, absolutely. But Jeff Akers is a certified financial planner practitioner, so am I. Jeff's been working alongside me 23 years. He's getting the hang of it now, I think.
I'm finally starting to.
Yeah. What's cool is there's certain things in the wheelhouse, and this topic, generosity, tithing, and legacy, is one of our favorite things.
Oh, yeah. It absolutely is.
It's we think about clients that we've helped them do what they wanted to do with their money. It just is incredible to help them.
Right. Yeah.
And it's a lot of fun to do that. Yes, it's fun to grow and double money in stocks. We do love that. But then when people give it away and to see all the enjoyment that comes from the giving away,
right,
that's cool.
Yeah, when they come and they say, this is where my heart is, and we can talk to them about, well, here's a way to give to that.
And then we follow through, and it actually happens, and then it's like, wow, let's do that again.
Right.
And that brings us to the third quarter topic. This is the second half of the show. The show is called Generosity, Tithing, Legacy. This topic is this. At what age can you give straight from your retirement account? What is that age, Jeff?
Well, the age is 70 and a half. That used to be the age of required minimum distributions from IRAs. Mm-hmm. They've raised that age, but they left the age that you can give directly from your retirement accounts. They left that at age 70 and a half.
All right, so what we're talking about is at 70 and a half, if you have a retirement account where you put money in pre-tax, this is not for doing with your Roth.
No.
This is for doing with pre-tax money you put in 401ks, 403bs, simple IRAs, regular IRAs, TSPs, anything like that. This is a way when you're over 70 and a half, and you have to be exactly over 70 and a half, you have
right.
Not the year of, but over 70 and a half, you have the ability to do something called a qualified charitable distribution. The old QCD, which is not that old, but it's been a pretty good rule. Jeff, can you explain what qualified charitable distribution is and some of the basic rules of it?
Right. So earlier we talked about you might give to a charity and then realize you couldn't deduct it because the standard deduction's higher than your itemized deductions would be. Well, the qualified charitable deduction, you give directly from your IRA directly to a charity. It has to be an IRA. It can't be an employer-sponsored plan. It has to be a traditional IRA. And when you give that money directly to the charity, it comes out of your IRA, but it's tax-free. So it shows up as a distribution, hard word to say, but it's not a taxable distribution. So it doesn't matter if you're taking the standard deduction because this happens way up the tax return before you ever get to even the adjusted gross income, which determines how much of your Social Security is going to be taxed. So it can have a tremendous tax benefit for folks just to give directly from their IRA to a charity. There are limits.
Absolutely limits. And you've hit the limits with one of your clients, right?
I do, every year.
And what is that limit per person?
$100,000 per person per year.
So that means if you have an IRA, it's pre-taxed, and you get to an age, right now at 73 is when you have to start taking withdrawals. Mm-hmm. That withdrawal typically comes into your income, all taxable.
Right.
That's above the deduction line, so that hurts everything like IRMA, which is the basically Medicare taxes bringing that up.
Right.
It also hurts your Social Security taxation. The IRA withdrawal does. It kicks people into new tax brackets. There's a lot of things.
Right.
Now, below that is that standard deduction or itemized deduction that we talked about in the first quarter, and that's where charity goes.
Mm-hmm.
If we do this, qualified charitable distribution, so what you do is this. I heard on the radio some qualified charity thing, whatever that was.
Right.
You could remember QCD and just say, oh, I got to talk to Acres Financial about QCD.
Right.
Make that the topic, and we'll go over this with you, how to make it work in your financial life. But the idea is this. The RMD might be, say, $40,000 you got to pull out this year, and you're like, I don't need all that money. I don't want to pay tax on it. What are my options? And one of these options is this. The charities you already give to, let's say you give $3,000 or $4,000 to charity each year. We get that list and we say, instead of out of your personal checkbook, let's take it out of your IRA account, your retirement account, and use it directly out of there. That'll reduce the taxation.
Right.
So if you put $4,000 in charity, instead of paying tax on $40,000, you're now paying tax on $36,000.
Yep.
Of course, you can do a lot more than this, but I just give you a quick example. And that gives us the ability to lower the top line income right away by giving it directly to charity. It becomes a fact that you put that money in pre-tax, it grew tax deferred, and you gave it away, and Uncle Sam was excluded completely.
Right. And there are plenty of clients that have come in their first year of taking required distribution. They're like, I don't need this money. I don't want to take it out. We're like, well, sorry, it's required. You have to. So this is a way to say, well, you don't need the money. You've been giving to charity anyway, so let's give this money to charity, keep the other money in your checking account, and we'll keep your taxes a little bit lower by doing it.
Right. So let's say you're younger, you're not 70 and a half. You're like, oh, I don't need to hear this part. What I got to tell you is this. How about planning for this throughout your life? We love Rothification of your life, where you put money pre-tax. Well, guess what? The match at the 401k is, you do money after tax called a Roth.
Right.
Your match is currently pre-tax.
Right.
That match portion when you retire gets separated. You have a Roth and an IRA. That IRA, you guys, what am I going to do with it? And you say, well, if I don't need it, that IRA portion, the match of your 401k, everything else you have is Roth. You can say, I'm going to live off my Roth. I'm going to give away my match.
My traditional, and not pay tax on it.
Yeah, and that's not a bad idea.
No. I've got a client who he's planning right now towards retirement. He's not old enough to retire, but we're doing some Rothification, converting to Roth, but he likes to give to charity. Mm-hmm. So I'm like, well, let's not convert some of this, because we'll just give that to charity when you're 70 and a half, and your taxes are going to stay low because there's no tax on that. We can do all the giving from there, and you can live off the part that we have converted to Roth.
Just in the last 5 days, these are the things that I've done.
Uh-oh.
At the end of every year, every time you meet with a client about their RMD, usually it starts end of January, start doing this. We say, what would you like to give to charity? So we get a list. That list is what charity, the address, what the amount, and do you want to designate anything special? We have the form. The check goes directly to the charity, and it's done.
Right.
So we've done it. I had one the other day where we had 8 different charities checks were going out for. That was fun.
Yeah.
I had another case where we're going over their estate planning, and in their will, they had give it to son and daughter and then 2 charities. I came to them and I said, well, how about we think about making your IRA beneficiaries all charity, 100%, and give all the rest of the money to the 2 kids, because that's all relatively tax-free. And so the IRA goes from being pre-tax and taxable later to never taxed by giving it ultimately to charity as a beneficiary. And then I also did their withdrawal entirely. In that case, we did the St. Jude's. We gave money to that. And so that was just a case where we gave a lump sum to the St. Jude's for this year, and we're going to keep doing it. And the idea is that you take your financial goal, your vision of what you want to give to, and make it happen, especially when you're over 70 and a half. The younger you are, can build these buckets of money so you can do this also later in your life.
Right. And St. Jude's is a popular charity because it's children.
Absolutely.
And so everybody likes helping.
And every TV
children.
ad makes you just watch
Makes
it for
you
half
want to cry.
Yeah.
Yeah, that's true. But the idea of giving your IRA money to charities, I don't like it when we have one IRA and we say, well, part of this is going to go to charity and part of it's going to go to my kids. I'd say, well, let's split that so that we're going to have one IRA, and the only beneficiary for that is the charity. And if you want to give other IRA money to your kids, have that in a separate account.
In fact, that is the rule now. If you want to have proper eligible beneficiaries, you got to separate your charity from your kids. You can't split it all as a beneficiary. You can't give 20, 20, 20, like divide it to 5, 2 charities, 3 kids. You rather designate one account to that charity and the other account to the kids. Right.
So it's a minimal headache now to have an extra IRA, but it's a significant headache saver for the kids down the road when they're filing their claim.
Allows them to take money out over 10 years rather than losing that right.
Right.
And so this is something that we catch when we're doing reviews, and when people come in and have us review where they are. We say, well, what's your goal with this? It looks like your charity is part of the beneficiary tree. Mm-hmm. They need to be all or nothing.
Right. So that's why it's important to come sit down with us. Let us go through everything, including beneficiaries, to take a look at that.
The other thing is this. I had a client receive a inherited IRA from their 90-year-old parent. They're 71 years old, and they're like, what do I do with this money? And I said, you're over 70 and a half. Mm-hmm. A BDA, a beneficiary deferred IRA or inherited IRA, you can give that to charity if you are over 70 and a half.
Right.
And that's a way to avoid taxation, and you can give things maybe in that parent's name. You know, it's pretty fun.
And like Brian mentioned, the current rules are you're going to have to take it all out in 10 years anyway.
Mm-hmm.
Well, if it's really big, that could be a big chunk of money that you got to take out every year. If you're giving it to charity, no tax on it.
Giving to charity because our heart says so. Generosity, that is something that we want to do. It also helps with building a legacy, supporting things that you want to last, things that you want to give to that will last beyond you. You've seen many people with a lot of money do this, but you should know that most charities are built by the small dollars, built by the small amounts that are given, by the widow's mite, the widow's small piece, the heart of people. That's what helps the charities.
Right. That's why when you get these letters, the fundraising letters, they're asking for $25 or $50. They're not asking for hundreds of thousands. Mm-hmm. So the idea is, where is your heart, and give what you can to that.
Understanding that in planning, plan giving and doing generosity planning is a part of financial planning. It's not just a whimsical little topic. It is a big deal when it comes to making this work for you and your family. And that's exactly some of the bigger topics that we still got to cover, right, Jeff?
Right. How can we be efficient so that the most goes to where it needs to?
And that's legacy. So the show today is called Generosity, Tithing, Legacy. Now, we all know that the best part of retirement is going to be getting your time back. And guess what you can do with that time? Generosity, give your time back. You can be involved in these charities on a daily basis. You can go visit them because you have your time back. You can decide how to use your time. Before retirement, you couldn't. You didn't have the free time. Now you do. So the main job, you could give some to charity. Consider that when you think about winning in your retirement years. That is winning in retirement. So if you want to win in retirement, go to our website at acresfinancialgroup.com. Scroll to the Schedule a Meeting section and let us know you'd like to schedule with a free consultation with one of our team of advisors. You could list qualified charitable distribution on the website there, and then we will know the topic so we can give you the information and get our meeting started. So go ahead, go to our website, acresfinancialgroup.com, or call us at 833-WIN-RETIRE. That's 833-WINRETIRE. We'll give you a call on Monday to schedule your free in-person or Zoom meeting. Go to acresfinancialgroup.com or call us at 833-946-7384 to start planning for your retirement now. What are the best assets to give away? We will explain when we return in a minute.
You're listening to a pre-recorded show. Welcome back to Winning in Retirement. Call 833-WIN-RETIRE now to schedule a visit with Brian and his team and begin winning in retirement. Once again, here's Brian Akers.
Welcome back indeed to Winning in Retirement, our radio podcast. We welcome you each and every Saturday morning to the show. And today's show is called Generosity, Tithing, and Legacy. And we brought Jeff Akers, co-host, in to talk about this. Throughout the show today, we've covered topics such as giving to charity and understanding that you need to know where your money goes represents where your heart is. Mm-hmm. And then we led into tithing and what that means to us and how it can be extremely important to helping understand the priority of money in your life. Then we talked about retirement assets as a way to give in your retirement years and to avoid taxation completely from your pre-tax accounts. Now the fourth quarter, this is a great topic, and I know everybody can't wait for me to tell it, but I'm going to wait. So you go to our website, acresfinancialgroup.com, and you can hear this show again right on our radio tab. It says radio podcast. Hit that. You can see these shows right there. You can do it that way, or you can just type it in. Winning in Retirement pops right up. All right, the topic here is this. What are the best assets to give to a charity? What are the best assets to give away? So, Jeff, we're going to cover our financial planning mindset on this, and we're going to talk about different types of assets to give away and why it might be important.
So my basic answer is anything that is going to be taxable, but if you give it to charity, it's not. That's the best asset to give to charity.
Because effectively, instead of just giving $1, you're giving the 30 cents. Like if you bought a stock for $30 and it's worth $100, you've given away, you gave $30 to the stock, now it's worth $100. You're giving $100 to charity,
right,
but you're not paying tax on that gain.
Right. And there's capital gains. There's also on retirement accounts. We've talked about that. That's what I love giving to charity, because that's money that you've saved. You didn't pay tax on it when you saved it, and now it's grown, and you didn't have to pay tax on that growth. And now you give it to charity, and you don't have to pay tax because it went to charity, and the charity doesn't pay tax. So I love giving that way. Right.
So like I was saying earlier, is that this last week there's been a lot of charitable things going on. One of them is where, okay, the longer story is the client worked for a company their whole life, and they bought company stock.
Okay.
So we did something called a NUA, where you can avoid large taxation on owning company stock with a big gain, and you pull the stock out.
Right.
Once you pull the stock out, what do you do with it? Well, what we did with it is we gave $15,000 to a charity. And so we avoided the actual gain that we avoided by doing an NUA. So
right.
I know that might not mean a lot to those driving around, but if you worked for a company a long time and you have a lot of company stock and maybe you bought it for $10 a share and it's worth $70 now, how do you avoid the gain? How do you avoid paying ordinary income tax?
Right, on the whole thing.
That's one of the ideas I did this week. So it's and you don't have to be extremely wealthy for that. You just got to save your money through a lifetime.
Yep.
And they were at a great company. The stock grew a lot. And this is not just something we do once in a while.
Right. These are ideas where we're being tax efficient. It's not necessarily that we're going to avoid all tax, but we're going to be efficient in paying taxes.
Other items we've done over the years. One is someone had real estate. The real estate went up, and they just didn't want to pay the tax on it. They want to give a certain amount of money to a charity. Now, they're going to give $300,000 to the charity, and they only show $100,000 of income. So the amazing thing about charity, if you have a real big year and you give something large real estate, you can get a deduction that year, and whatever you can't use, it goes forward.
Right. You can carry forward the amount that you couldn't use for up to 5 years.
Now, there's different rules inside charitable deduction between 50% of your adjusted gross income or 60% on cash versus non-cash. Right. Not going to cover all those options today, but the idea roughly, if you had $100,000 of income, you gave $300,000, it'd take you 6 years, $50,000 a year. But there are some other ways of doing things.
Right, to use it all up.
So that's just an idea of some real estate that we've done. We've done the stocks. We do that
right
a bunch of times.
Yeah, we've done stocks. We've done life insurance. You might have the beneficiary. That's a way to do it.
Life insurance, to get a deduction, you have to give the ownership to the charity, not just the beneficiary. If you make it just a beneficiary, you don't get a deduction at all. So in life insurance, I recommend that you give the ownership to the charity and make sure it's a paid-up policy so they don't have to pay a premium. That's not really nice to do, right?
Right.
But you get a deduction for the cash value of the life insurance when you do something like that. You have one of those old policies, that you bought in 1948. It's worth $500. It's $500 death benefit. There's $300 in it. Mm-hmm. You can get a $300 tax deduction by giving the charity, and then they cash out when you pass away.
Right. I've got one client that had a bunch of IRA money. Also had some money that was in non-qualified annuities and then a bunch of stocks. And so they had certain charities that they wanted to give to when they passed away, and they also had kids that they wanted to give some money to. So we went down the line and said, okay, well, let's give the IRAs to charity because they won't be taxed, where your kids would be, and we're going to give the stocks to your kids because they'll get a step up in cost basis on those stocks so that their tax will be minimized by doing that. So there are definite efficiencies, an efficient way to give to charities and to give to your family or other people that you want to give to.
Yeah, so that topic, legacy, one of the things that I've done recently, which I really liked the idea, and that is this. The IRAs went to charity, And then we did a wealth replacement. A wealth replacement that we had life insurance that then goes to the kids tax-free.
Right.
So we've cut the IRS out because we've given money to charity out of the IRA. And then we're buying life insurance, which is also tax-free.
Right.
So we've had a combination of who you want your money to go to. Well, this is what's done by many people as you get higher and higher net worth. If you're in that 25 to 30 million, where these federal taxes of 40% start to take a lot of money, these are techniques that we've done and used for people. It's a really great idea to take money and understand how to deliver it as a legacy for your family and for the charities that you want to benefit most.
Right. Maximize what the end user, the person you want to have it or the charity you want to have it, maximize what they're going to get.
Absolutely. So when we're talking about this, there are other topics out there. One of them is the use of a donor-advised fund. That's a concept where you give some money now, it starts to accumulate in that fund, and then it gives out pieces of that fund per year. So it makes almost like your own personal endowment, and you could do this on a smaller basis. Typically, anything under $250,000, we rather use a donor-advised fund if you want some control on what charities it goes to. As the amount of money that you want to give the charity goes above $250,000, we have done and are doing private foundations for clients where we set up a 501c3 foundation for them and their family control how we distribute the assets each year. We invest it based on the priorities of their giving, whatever that might be ESG, it might be biblical-based investing, it might be really whatever they want that to be when it comes to investing that money to go to the charities every year.
Right. I've even seen you use it for like Christian education, kids that want to go to Christian school and helping with their tuition there.
Yeah, absolutely. We've done that for a few different people. The idea of donor-advised funds is smaller and private foundation is larger. The larger the foundation, then that allows for the cost of making it happen. Right. There is accounting costs on a private foundation each year for reporting purposes. For nonprofit, there's like getting it up and running takes a while. We have a specialized CPA we use for those cases.
Right. So you do want to be aware there are costs involved in a lot of these processes. The simple ones, they don't really cost much when you're giving.
The cost comes down to private foundations. The rest of them are just normal planning. It's just sometimes not all investment people know about these ideas.
Right.
And so if you bring up, I want to do a QCD on my RMD or my BDA, and then might go, what?
What was that? Yeah, we do want to be careful because even if they know about it, they might not mention it to you. And so we want to make sure that our clients are doing what's best to get the maximum where they want it to go and not detoured over to the IRS.
And there's one family where they use the foundation as a way of having a legacy of giving in their family, where the family gets together and they decide how much to give per year out of the money. So let's say they it's $500,000 in there and they want to give away 5%, $25,000 a year. The family actually gets together and votes who it should go to, and they've had the kids be involved since the very beginning, so that everyone understands that it's there, and they all are seeking out areas to donate to.
Right, they're involved in it, and that again creates a habit of being interested in giving to others, helping the community, helping other folks that might be less fortunate.
So the idea today is this: winning in retirement is exactly our goals for our finances when it comes to building and growing our finances for those retirement years, to take care of us when we can't work anymore. Now, as we grow and accumulate and the better money decisions that you make, you're going to grow wealth over time, and there might be extra. We believe that if you have a heart to generosity, what's going to happen is your relationship with money is going to change, and you're going to end up having extra because you're going to live well within your means. And that'll drive the concepts of generosity, which would lead to working on tithing and other giving, and then building a legacy for your family for a lifetime. And that's exactly what this show has been all about.
Right. We've talked about different ways to give. We've talked about different reasons to give. And so I hope that this is something that you're listening to and thinking, well, where is my heart? What do I want to support? And then you start moving in that direction with your time as well as with your money.
It's basically the vision that you have for the charity that you might want to help. You want to check them out, get to know them, understand. If you need to create your own charity, we have multiple clients that have done that. And then what's neat is when you go to opening day of certain events, it's nice to see these charities in action.
Right. It's Yeah, it's just exciting to see what people have where their hearts are, and see what they're interested in and how they're able to help out folks.
All right. So the show, if you go to our website, acresfinancialgroup.com, you can, under the radio podcast tab, you can get it. You see our shows right there. You'll see it, Generosity, Tithing, Legacy. Go ahead and check that back out again to understand any certain topics. But the main thing you got to understand is just give us a call and let's go through these ideas and see how it applies to your situation. Because this, I think, matters for now and for the long term.
All right. And we've talked about a lot of different things. So please give us a call so that you make sure that you understand what it is you're doing, what you can do.
And what happens anytime during holiday periods, people always are thinking about giving, how to give. When it comes to charity, understanding what you own and how to give that can really help you in many different ways. So understand how it all works together. Thanks very much, Jeff, for a good show today. I appreciate it. Good effort.
My pleasure.
I'm glad you're here today, Jeff. Thanks very much. All right. We want you to win in your retirement by taking advantage of this opportunity to begin planning with us at Acres Financial Group. To schedule your free meeting with one of our team of advisors, go to our website at acresfinancialgroup.com. Scroll to the Schedule a Meeting section and let us know you'd like to schedule your free meeting. That's acresfinancialgroup.com. Or you can call us at 833-WIN-RETIRE. That's 833-WIN-RETIRE. We'll give you a call on Monday to schedule that free in-person or Zoom meeting with one of our team of advisors. Start planning for your retirement now. Go to acresfinancialgroup.com or call us at 833-946-7384. Thank you for listening. I'm Brian Akers from Akers Financial Group, and we want you to be winning in retirement.
You've been listening to Winning in Retirement with your host, Brian Akers of Akers Financial Group. Akers Financial Group offers securities through Archedios Capital, an SIPC and FINRA member firm. Advisory services are provided through Archedios Wealth. Akers Financial Group and Archedios do not share any common ownership. Neither Archedios nor Akers Financial Group provides tax or legal advice. Advice given on winning in retirement is general in nature, and one should seek further advice from their financial advisor, broker, attorney, and or tax accountant before investing. Be sure to read each prospectus carefully to understand all the risks associated with each investment. Examples and scenarios shared are meant to be for illustrative purposes only. Past performance is not indicative of future results.